the dollar will continue to benefit from a broad-based system of flexible exchange rates. So this is based on the opinion of Nuria Rubini, and the folks at MarketWatch carried that piece, and it reads. Nuria Rubini says reports of the dollar's demise are greatly exaggerated. Cyclical factors explain today's weakness, while the longer term outlook for the dominance of the US dollar is more ambiguous. And he went on and said the recent sharp depreciation of the US dollar has led to concerns that it may lose its role as the main reserve currency. After all, in addition to the Federal Reserve's aggressive monetary easing, which threatens to debase the world's key fiat currency even further, gold prices and inflation expectations have also been rising. But to paraphrase Mark Twain, reports of the dollar's early demise are greatly exaggerated. The dollar's recent weaknesses is driven by shorter-term cyclical factors. In the long run, the situation is more complicated. The dollar has both strengths and weaknesses that may or may not undermine its global position over time. Negative factors. Chief among the short-term negative factors is the Fed's ultra-loose monetary policy, with the United States monetizing ever larger budget deficits. The Fed's approach looks more accommodative than most of the other major central banks. The dollar tends to weaken during risk episodes and vice versa. This is why its value peaked during the February to March panic over COVID-19, and then weakened from April onward as market sentiment recovered. Moreover, the Fed's activation of currency swap lines with other central banks is the dollar liquidity that had been pushing the exchange rate higher earlier in the crisis. Now a flood of global dollars is putting downward pressure on the US dollar. Moreover, some developed countries in Europe and elsewhere, and some emerging markets such as China and others in Asia are doing a much better job of containing COVID-19 than the United States is, implying that their economic recoveries may prove to be more resilient. The public health failures and related economic vulnerabilities in the US and thus are thus further contributing to the dollar's weakness. It also bears repeating that before the pandemic, the dollar had appreciated by over 30% in nominal and real inflation-adjusted terms since 2011. Given the yawning US external deficit, and because interest rates are not high enough to finance its capital inflows, a dollar depreciation was necessary to restore US trade competitiveness. And the US turned to protectionism signals that it prefers a weaker dollar to restore external competitiveness. Dollar could strengthen. Even in the short run, the dollar could strengthen again if, as the latest global growth data suggests, a V-shaped recovery stalls into an anemic U-shaped recovery, let alone a double dip. If the first pandemic wave is not controlled and a second wave kills the recovery before effective vaccines are found. In the medium to long term, multiple factors could preserve the dollar's global dominance. The dollar will continue to benefit from a broad-based system of flexible exchange rates, limited capital controls, and deep liquid bond markets. More to the point, there is simply no clear alternative currency that could serve as a broad unit of account, means of payment, and stable store of value. Furthermore, despite its pandemic travails, the potential annual US growth at around 2% is higher than in most other advanced economies, where it is closer to 1%. But obviously not including that of China. The US economy also remains dynamic and competitive in many leading industries such as technology, biotech, pharmaceuticals, healthcare, and advanced financial services, all of which will continue to attract capital inflows from abroad. A country vying for the US position could have to ask itself if it really wants to end up with a strong currency and the associated large current account deficits that come with meeting the global demand for safe assets, government bonds in this case. This scenario seems rather unattractive for Europe, Japan, or China, where strong exports are central to economic growth. Under the current circumstances, the US is likely to maintain its exorbitant privilege as the issuer of safe, long-term debt that private and public investors want in their portfolios. The longer outlook. The question then is, what factors might undermine the dollar's global position over time? First, if the US keeps monetizing large budget deficits, thereby fueling large external deficits, a surge of inflation eventually could debase the dollar and weaken its attractiveness as a reserve currency. Given the current mix of economic policies, this is a growing risk. Another risk is the loss of US political hegemony, which is one of the main reasons why so many countries use the dollar in the first place. There is nothing new about the hegemon's currency being the global reserve currency. This was the case with Spain in the 16th, Dutch in the 17th, France in the 18th, and Great Britain in the 19th. If the coming decades bring what many have already called the Chinese century, the dollar may well fade as the Yuan, also known as the renminbi, rises. Weaponization of the dollar via trade, financial, and technology sanctions could hasten the transition. Even if American voters elect a new president in November, such policies are likely to continue as the Cold War between the US and China is a long-term trend, and US strategic rivals China and Russia and allies alike are already diversifying away from dollar assets that can be sanctioned or seized. And the trade, the Cold War between China and the US, yes, indeed, is way beyond party politics. You know, it's a national issue, and no president would want to be the one that gave China the room to emerge, especially with how it has been deemed for some time now. You know, especially with its profile, its history, you know, its record. You know, so no U.S. president is likely to give China that room. You know. So at the same time, China has been introducing more flexibility to its exchange rate, gradually relaxing some capital controls and creating deeper debt markets. It has convinced more trade and investment partners to use the renminbi as a unit of account, means of payment, and store of value, including foreign reserves. It is building an alternative to the Western led Society for Worldwide Interbank Financial Telecommunication, SWIFT, and working on a digital renminbi that eventually could be internationalized. And its own tech giants are creating huge e-commerce and digital payment platforms, Alipay and WeChat Pay, that other countries could adopt in their own local currency. So the dollar's position is safe for now. It faces significant challenges in the years and decades ahead. True, neither China's economic system, state capitalism with financial controls, nor its technocratic authoritarian political regime has much appealed in the West. But the Chinese model has already become quite attractive to many emerging markets and less democratic countries. Over time, as China's economic, financial, technological, and geopolitical power expands, its currency may make inroads in many more parts of the world. This is without any doubt the case. China will definitely emerge and will take its place, regardless of whether we want it or not. Okay, there's a piece also here about China, and what does it say here? US-China trade envoys hold meeting to discuss coordinating economic policies. This was yesterday. Okay, the US and Chinese trade envoys discuss strengthening coordination of their countries' economic policies during the phone meeting Tuesday. The Ministry of Commerce announced. The announcement gave no details of the meeting held as part of the Phase 1 truce aimed at ending a tariff war between the two biggest global economies that has disrupted worldwide trade. President Xi Jinping's government has lobbied Washington since at least 2016 to coordinate macroeconomic policies. Beijing has no details, but such policies can include economic growth, employment, inflation, and trade. Tuesday's meeting included Vice Premier Liu He, U.S. Trade Representative Robert Lighthizer, and Trade and Treasury Secretary Stephen Mnuchin, the ministry said. Okay, we don't have to read everything about that. So there are a few links on that opinion by Nuria Rubini. Of course, you know we cover a lot of his opinions on this channel. And this is also another piece on the US dollar, but it's not by Rubini. It says the US dollar's sharp decline is driving this investment manager reluctantly into gold. Spiraling debt, slow COVID-19 response, and trade wars could spike prices, inflation, and interest rates for Americans. The US has competitive advantage globally that are rooted in its geography. But the reason the US dollar became the world's reserve currency is that America has had the largest, strongest, steadily growing and conservatively financed economy and a stable political system anchored in the US Constitution. Yet for the dollar to continue to be valued, the world has to believe in it. Since the end of the World War II, that has been the case. People basically looked at the US and many of them concluded that it was the safest place to keep their savings. They didn't have to worry that that if they put their money in the US dollar, it will lose its value. The dollar was not going to be diluted by hyperinflation or burnt up by a foreign or civil war. The US political system was stable and strong, and people didn't have to worry that at some point they wouldn't be able to take their money out of the US banks. The problem with being envy of the world is that it changes your behavior. You start believing that you are very special for reasons that are not grounded in reality. You start believing that bad things happen only to other people and nations because they are not as special as you. You can do anything you want, borrow and spend as much as you like, and nothing bad will happen to you. This behavior in turn starts to undermine the core reasons why people trusted your country and currency to begin with. That is what is happening to the US. In 2020, the ratio of the US debt to the output of the economy, debt to GDP, is likely going to exceed 120%. And might be as high as 130%. You might blame the coronavirus pandemic for some of that, but the national debt has been going up steadily. The US run huge budget deficits in bad times and in good times long before the virus. In 2000, the debt was $6 trillion, a 30% debt to GDP ratio. It was 14 trillion in 2010 and 23 trillion in 2019, increasing 1 trillion a year while the US economy was booming. Or maybe this is why the US economy was booming. The US was charging 1 trillion a year after year on its national credit card to buy things and to engineer this growth. By 2019, 10 years after the great financial crisis, the Fed was still running its policy of quantitative easing. Debt to GDP at the time topped 100%, eclipsing the EU's ratio of 6%. Yes, the capitalist US is more indebted than the socialist EU. We have not acutely felt that burden because interest rates declined over the last 2 decades. The COVID-19 arrived, the US has spent 12% of GDP so far to keep its economy afloat during the shutdown, twice as many in terms of GDP as the rest of the world, 4 times as many as the largest EU countries, 3 times as much as Japan. Our debt has skyrocketed by perhaps another $6 trillion. It's too soon to tell. The Fed already owed $2.5 trillion of US government bonds in 2019, and now it owns $3.7 trillion worth, and is a buyer of US corporate bonds and ETFs. Stocks are likely to be the next. Okay, you're going to find this link in the description box below as well, and read up more for yourself. Okay, thank you very much for join us and read up more for yourself on this video. Okay, thank you very much for